Good morning. This is MrNotAdvice. It is Wednesday, July 15th, halfway through the month. As always, this is for entertainment and education purposes only. Today, I'm going to be covering indicators, and I'm going to tell you the ones that I use, what my history has been as I learned about indicators, and some of the common traps that we could fall into when we're looking at indicators. So I'll start off right off the bat. The most common mistake that people make when they use an indicator is they use it as a buy signal, right? And why is that not a good idea? Well, here's why. Every indicator is built off of price. Therefore, every indicator is a derivative of price. Therefore, every indicator is going to be less predictive than price itself because it's an indicator. As a retail or even a professional, when I joined the business, what I was faced with were thousands of indicators. Look at all these indicators on Thinkorswim. And if you're like me, when you choose an indicator, you're probably looking at it like, oh, somebody said this is a really good indicator. I think I'll use it. Well, the problem with that is most people do mistake number one, which is, oh, I think I'll use an indicator to tell me when to buy and to sell. That's not what an indicator does. So I want you to think about indicators like this. I'm always talking about probability and putting probabilities in your favor. And the way we trade is we use a price chart and then we go to math and we measure, will the stock move given its IV, its implied volatility? Will it move enough in the time frame for my trade for me to make enough money in my option trade? Now, my option trades are, as you know, if I don't make money in 3 days, I'm going to close it, or if I hit my stop in 3 days. So they're much shorter term, and I think the efficacy of an indicator, the longer the time frame you use on a look back period, okay, the further back you're using for that indicator, the less efficacy it has for predictive power in the future. Just like price action, right? If I'm going to look at EOSE's price action, the most recent price action is going to be the strongest indicator of therefore the next couple of time periods. What we often do is we will, and that's why, again, I teach to read charts backwards, right? I say start with this candle here and then move backwards. But every indicator is a derivative. And the way I want you to think of them is, okay, I have a price chart. It's breaking a support or resistance level, whether I'm going longer on the math. Will it move enough given the IV? Okay. And there are online calculators to compute a hypothetical move. And then the indicators are what I weigh. They add or take away from my trade thesis, meaning if I have, and I'm going to put an indicator up here, these are the only indicators I use for when I use them. The blue line is the 200-day moving average. Why? Because as some of you have heard me teach before, there are literally professionals that have the 200-day as their buy or sell line, okay, the Maginot line, right? In fact, Bill O'Neill, who started the newspaper, Investors Business Daily, has a hard rule. If a stock price is below the 200-day, he will not go long. If it's above the 200-day, that's the only time he's allowed to go long a stock. I use it, and this is a very important point. I use the 200-day and any other moving average that you see on here, okay, and I'm going to go through the other ones, but I use them because they are the most widely used. I'm not speaking to whether they have great predictive power. I just know that a majority of the market participants love the 50, they love the 200, they love the 21. And each of those time frames relates to the price expectation or horizon for your trade. I'm not using these indicators or these moving averages because I have great faith that they statistically work. I don't. I know Charlie Munger made a statement and said, if all you did was buy the S&P 500 when it was above the 200-day, you'd make money. That might be true, but I don't think it's true because of the efficacy of the 200-day moving average. I think it's true because so many other people use the 200-day moving average. The 50-day is the moving average that I pay attention to much more than the 200. If you're using the 200-day moving average as your primary indicator to guide, then your time frame for your investment trade or your trade should be greater than 6 months. This is a long-term time frame. And look how, I mean, if you look, it's 200 periods, 200 trading days. And therefore, you've got data points that are very, very old. Now, there is the discussion about whether you should use exponential moving average or a weighted moving average or even a weighted exponential moving average. This is where you start getting into this refinement of a simple indicator and then making it more complex. I believe that majority of the indicators that have been released beyond the ones that are pure math are because of what I call curve fitting. Somebody decided that they were going to tweak an indicator and it worked for them. But I don't think, and I don't know anybody who uses indicators and trades off them successfully. It's always for me the price action first. And then after that, I go through my indicators and I decide whether or not it's adding to my risk or adding to my potential success. That's all I weight them as. Yellow line here is the 21-day indicator. I have that on there primarily because I've been testing it for my swing trades. But the primary indicators that I like to see on a moving average are the 200 and the 50, and that's because everyone else uses them. I treat these as resistance or support levels. So if once price on EOSC gets up here, I would wait to open a new trade till we closed above it because there are so many market participants that are using it. Well, the other indicator on this chart is this standard deviation channel, right? It's 45 days. Why 45? Well, 45 days is very simple. The theta cliff for every option is 21 days, right? At 21 days, your option contract is going to decay. And to review, so there are three components to an option price. You have the underlying price, okay? You have the IV, and then you have the time. Well, there's only one of those that is going to decay in an arithmetic straight line decay, and that's time. And at about 20 days, the time or the theta decay in the option contract becomes so much that the other two variables cannot overcome it. What are the other two variables? Price and IV. I have a standard policy that whatever my time frame is, I double it. So I took 21 days of the theta cliff and I said, I'll just double it. I made it 45 days. Look, whether you use a 30-day standard deviation channel or you use a 50-day standard deviation channel, the faster, the shorter the time frame, the faster the indicator is, but it also is more prone to giving you false confidence, right? So it's finding that in the middle sweet spot. And over 28 years, I have found the 45-day to be excellent for what we do. When I use the 45-day channel right here, this is all I'm looking at. Number one, what's the angle? This thing's headed down. That doesn't mean I won't go long, but I do have to take a look and say, well, the short term price structure has been in a downtrend. So be careful going long. What would that cause me to do? Size down, just size down my position. The red lines are your -2 and +2 standard deviations. Your orange lines are +1 and -1, and your white is the mean. One of the things that I want to know is historically over the last 45 days, where has price traded? Well, for EOSC, you can very clearly see that this thing has been trading between the one standard deviation, right? Here and here. How is that a good indicator of when risk might be in your favor to trade a stock to the long or to the short side? Well, here you go. If this price was up here against plus one standard deviation, it's going to make the trade more aggressive. Why? Because the previous times it's been up here, what's it done? It's gotten rejected. Yes. However, where if I'm able to enter a low close doji tomorrow, where am I entering? Right at the mean. So just on the last 45 days, it appears to me that price has a shot at going to what? Plus one SD, which is $6. Doesn't mean it's going to go there, but I'm putting something in my favor as opposed to going long when it's at a plus two or a plus one standard deviation, especially historically. Why does a standard why do these matter? Because bots and algos, who make up 70% of the overall volume in the market every day, they are programmed in ones and zeros. And one of the favorite trades that institutions like to program their bots and algos is reversion to the mean. When price gets extended, they will then wait for it to get extended. Usually they use a plus two or minus two standard deviation. Okay, these red lines. And if it got up here, they'd short it. If it got down here, they go long. Oftentimes, though, price is not going to give you that clear of an indicator relative to the standard deviation channel. So you have to drill down and look at the individual personality of the stock price and how it reacts to the 45-day standard deviation channel. Another indicator that I have used in the past, but we no longer use, but I like to keep it up here, is this on the right-hand side. This is called your volume profile, right? And your volume profile, this line right here, 620, you can treat that as, well, first of all, the definition of it is the price where the most volume has traded hands in EOSC over the past year. Why is that important? It acts like a magnet. Price wants to return there. It's not going to do it immediately, but price over the long term wants to return to this. When I say long term, my concept of long term is over 90 days. Okay. Anything over 90 days outlook is a longer term trade to me. So price wants to return here. But what's interesting, and you'll probably hear this from some market participants, they'll call, if you tilt your head to the right, these are actually volume bars. And so you'll hear people talking about trading volume shelves. And that's what this is. This is a volume shelf. See the spike up? So it would make sense, and it does make sense, as price enters a price area where historically volume has been high. That means there's a lot of market participants there that traded hands. Okay. So it can also act as resistance on the way up. Conversely, on the way down, this point of control, that's what this green line is called, the point of control, can act as support on the way down. So again, what do you do there? If I'm looking long, I sure as hell don't want my point of control to be right above where I'm entering. Why? It could act as resistance. Same thing. I don't want my 50-day to be right above where I'm entering. I want it to be at least 3 to 4% away. Why? It's going to act as, it could act as resistance because so many market participants use it. If you are looking longer than 90 days, I use a weekly chart and I do not pay attention to the indicators. I use indicators for daily charts. And if you think about the reason why, indicators are derivatives of price. And remember, I always say price is the best representation of all available information out there. All the news, all the rumors, inside information, lies, hypes, newsletters, whatever it is, price. As I'll repeat it again, every indicator is a derivative of price. So I always start with, and my decisions are made by the price alone. The indicators to me, again, are adding to either confirming, putting another data point in my trade's favor, or they're putting another data point against my trade. And how I treat them is if I've got all of my indicators are telling me it's a good entry level, okay, I'm not entering where historically the price is rejected to the long side, right? I'm not trying to enter up here. I'm entering above the point of control or not near the point of control, right? That allows me to keep my maximum position size of 4%. But if they were against me, I would already be sizing down. So it allows me to participate in a trade, but at the same time acknowledge that there's some longer term math involved that is telling me this is a higher risk area. Trading and entering trades is not a zero sum game. And what I mean by that is there is no methodology where you can write down, have a checklist, okay, and say, okay, I've got 5 things in my favor. It's above the 50-day, it's above the 200-day, they're both angling up, therefore I should go. Absolutely not. I use indicators for sizing, right? I also use it to help me establish what my confidence level is for that trade. So on my chart, recently it's traded between the ones, but this over the last 45 days, -2 it bounced, +2 it bounced. Okay. So how far do I think Nokia can go? Well, it's going to go all the way down to here just based off this indicator before I know that bots and algos are going to step in and play a reversion to the mean trade, which is this white line. Tesla definitely trades between the two. So if you're looking at Tesla and you're saying, hell yeah, I'm going to take this breakout. It broke above the 50-day. Great. I might get a cross. Great. Okay. The 21 over the 50. All great and bullish. But now if I said to you, hey, what do you think the risk is higher to go long here? Your answer should be, well, heck yeah. Because previously here, here, and here right now. We haven't seen this resolve yet, but previously, when prices got into +2 standard deviation, it's reverted. Where? Back to the mean. And price will continue to do this until you finally get a break. What's the other thing I don't like? I don't like that the standard deviation channel's down. But with my short-term time frame for trade outlook, I don't have to be in the trade for 45 days, right? I'm looking for a momentum burst and a reestablishment of a new trend. Let's do some basic understanding here. Standard deviation channel is merely a mathematical representation of probability. That's what standard deviation is. Remember back in school, you had a bell curve, and the middle part of that bell curve was one standard deviation. So, from a statistical standpoint, a lot of people misinterpret that when you get the +2 or a -2 standard deviation, that there's a 96% chance of a reversal. That's not what it means. What it means is over 10,000 data points on a statistical basis, but no matter what the data set is, that historically that the push in that direction is getting extended. Now you can solve that by just trading sideways for a while. So this is a perfect example where you may look at this chart and go, hell, looks like a great trade. It just recaptured the 50-day. We've done a cup and handle. Here's your cup. Here's your handle. Yeah, you could still take this trade depending on when your break level is, but I would be sizing down. Why? Because I know that there's going to be this attraction to a reversion to the mean trade. One of the questions I always get is, why don't you use a shorter time frame, like a 21-day? Well, because a 21-day just picks up a lot more noise. And again, relative to my trading, 21 days is where the beta cliff is. So my rule is whatever your time frame is, double it. So that's why I have to go out to the 45-day. The perfect number might be 41. It might be 43 at 39. I don't know. I am in the ballpark, okay, using a 45-day standard deviation channel. Before I go to these to review, the 50 and the 200 to me are merely break levels. I will not enter a trade if I'm less than 3% long, if I'm less than 3% away from either of these two moving averages. And again, I'm only using those because I know these are the moving averages that the majority of market participants use. This is right here is the MACD histogram, right? And first of all, the way to read this is bright green means buy momentum is growing. Dark green means buy momentum is slowing. And it's converse for red. Bright red, sell momentum is growing. Dark red, sell momentum is slowing. There's a couple ways that I like to use this. I'm going to go back to EOSC because there's and I put this out on Twitter. One of the things I like to look for are divergence between the MACD and price. So the MACD is the moving average, convergence, divergence histogram. Typically, traditional ones have two additional moving average lines. I took them off. In and of itself, because a stock has a big volume jump, doesn't necessarily mean you should be buying it or selling it. Oftentimes, volume is the result of a price move, not the cause of a price move. A couple things I look for. Number one, whether it's to the top side or the downside, and we'll do to the downside here. If this price was going down, I would be looking at seller for seller exhaustion using the MACD. How could I tell that? Well, number one, I want to see how much further sell momentum could go based on the recent history. Because if it's just getting started to the downside, see how much higher this is than these, okay? Then I would what? Size down my trade. But it's even more important to the top side. So Meta, beyond the price, look at how these line up. Where am I at on the 45-day? I'm well above the standard deviation channel, right? Okay, so risk is higher, not guaranteed. Risk is higher that this thing is either going to start consolidating or it's going to revert back to the mean. Number one. Number two, look at my MACD level. Look how high it is. So I look in the past and I look for previous spikes and I can measure, is there historically, is there momentum left? Because the MACD is something that bots and algos use as a secondary or tertiary confirmation for either a long or short trade. So if I was looking to go long Meta, I would be very nervous, or not nervous. I would absolutely be sizing down because I got two things against me. I've got it's trading at +2 standard deviation, and look where the MACD is. We're almost at a peak. I would much rather be going long when this MACD was down here on a breakout. It's adding and subtracting the plus and minuses for the trade. Let's go back to EOSC. One of the favorite things that I like to do is this. And you saw me post this in the room the other day. Let's look at it going up. You see how price came off this low and look how high the MACD went. Okay, so let's look at the peak right here on price, right? And then it came down and then we made a new high. But what do you see about the MACD? It didn't even come close. A new high should produce an even higher spike if the momentum is there. Again, we're measuring momentum. It's not saying whether the stock will continue to go up or down. What we're looking at is merely of the recent history. Are we seeing the same strength of momentum as price pushes higher? We're not. Then what happens? Then it tries to push again. And what happens here? This peak in the MACD is even less. So what would this do for me? I'd be very careful about going long if I saw this. Conversely, look at this side though. We made a new swing low right here. Then we made another swing low, hopefully. And what do we see? The MACD did not go as deep. So conversely, what is that telling me? It's simply telling me that sell momentum is slowing. I don't know the reason why. Well, I think I do. It's the rights offering. But what it's telling me is that sell momentum is slowing. That's good for a long position because maybe the sellers have become fully exhausted. So I like to look for when a stock makes a swing high and then a new swing high and make sure it's confirmed with by and with a new high in the MACD. But I'm also, as I said before this, I'm measuring the spikes in the MACD to see, do I have any more room to the top side? Well, from here I did. On the MACD, I still had room. The MACD for me is a complementary indicator that I'm using in order to measure the force of momentum, whether it's merely growing or whether or not it's shrinking, either to the buy or sell side. The one thing that I do not do, right, is, and I've seen people do this, they'll take this individual thrust down or thrust up and they'll draw a trend line on it. I don't agree with that. And for you nerds in the room, that's a third level derivative now. Now we've gotten 3 steps away from price. Now, the efficacy and predictability at that point is very small, and people who are doing that are just making shit up. So that's the MACD indicator, and that's how I use it. Again, it's not a go or no go. It has everything to do with position sizing. I always want to trade. The final indicator that I use is this. This is called a relative volume standard deviation. So here's my second volume component. And here's where this matters. I use this as for a very specific setup. It's called a gap and go. So when I get a gap to the top side, this is only to the top side, folks. When I get a gap to the top side, think about what just happened. They went to bed, and I know there was news, but they went to bed, and all of a sudden they wake up and price is up 16, 20%. Well, that's nice, but what do you want to be sure of? Any basic investor or new investor to say, well, was there enough volume? That's what relative volume tells me. So this dotted line is a 2 standard deviation volume spike, extremely out of the ordinary. I'm using statistics here. So statistically, this is a very out of the ordinary volume spike. How I translate that is this. If I get a gap and is it accompanied by a big green candle, right? Because it won't be green unless it's above 2 standard deviations, then that tells me a crap ton of money drove it up. They're not going to want to let it come back down. So one of our favorite trades is to, on a gap and go, confirmed with this volume spike, is for the price to come back down and go, or just to continue to go. We're catching momentum. Relative volume, as the name infers, is not an absolute volume component, because you'll see many days where it doesn't even register. What are those days? It means the volume was so low that it wasn't even at a normal 1 standard deviation. So it was a very low volume relative to the previous 60 days. That's it. That's all it means. It doesn't mean that, oh my gosh, look at this. Just because I have a big green candle, I should just jump in. Nope. It's a 2-step trade. It's called a gap and go. And that's what I use for relative volume. This is my confirmation on a gap. If I see this, and the bigger the better, okay, it is highly unlikely that all this volume that drove it up and put it up here is going to want to allow it to come down. Here's another thing that's happening. Relative volume is something that's used by institutions. They don't use straight volume. So that's going to be a trigger for them. What else is a trigger? Well, a gap is a trigger. And so oftentimes, what I'll do with these indicators is I'm trying to think as an institution does. What did I tell you when we started? Price above the 200-day moving average is a trade entry signal for longs for many institutions. You got that on this one, right? You got the gap, and then you got the volume momentum confirmation with the relative volume candle. Literally, these indicators I use have been what has allowed me to do over 700% for the last 3.25 years. It doesn't have to be that complicated. I see so many people that got a gazillion indicators on their chart, and what they're missing is every single one of those indicators is a derivative of price. So why don't you use price first as your primary indicator? When everybody asks me, well, what do you use as primary? Price. Okay. You'll notice what I don't have on here. I will show you this. Hold on here. Because different trade styles require different indicators. Look at this. This is my scalping chart. I mean, I've got multiple different indicators here, but believe it or not, these are all statistically based price indicators. So when I'm using any of these indicators, I have a mental piece of paper in my mind. I'm going long. Am I above the 200-day? No. Okay, that goes in the negative side. Am I above the 50-day? No, goes in the negative side. Do I have, am I going long when the MACD histogram is at a peak? No, that goes in the positive side. Did I experience a relative volume spike? No, neutral, doesn't score either way. I got two minuses and one plus according to my indicators. Oh, here's another negative. I'm buying it in a downward 45-day standard deviation channel. Oh, that goes on my negative side, right? So I'm adding these indicators up. I've already made the decision that price has broken my level. I'm going to take the trade. All the indicators are doing is whether or not I size up or size down. Now, you may sit there and go, well, that's great for the way you trade. But how the hell do I use that? Because I want to own stocks for the longer term. Great. Here's how you use them. Number one, you use your price chart that if you wanted to get EOSC for the long term, the first thing you're going to want to do is probably switch to the weekly price chart. That's whenever anybody says to me, I want to hold a trade beyond 90 days, I'm like, use the weekly. Let the weekly tell you. And here's why most people won't was they're afraid they're going to miss so much of the action. But my response is, hey, if this thing reverses and bounces, you told me it was for long term. What do you care if you miss the first 6, 7%, 10% of the move? If this thing does get going on the weekly, you have 100% gain. There's this obsession with getting in at the absolute bottom or getting out at the absolute top. And people think or somehow they make that the primary goal they're investing. That is to me entirely a pride and ego issue. If I was looking long term, because I have members that own this, okay, Micron. Let's take a look. Well, what do I see? I see that sell momentum is very strong. What else do I see? So that's a negative, right? Price just broke below the 50-day. That's a negative. What's a positive? Well, historically, over the last 45 days, when it gets down here to -1 SD, what happens? It bounces. Now, this is not the trigger to get in. You still would want to wait for a price level right here, this candle where price discovery previously ended. And what that means is they tried to take price up and it failed. There was a defined winner and loser right here. I've got on the plus side of my odds, I've got below the 50, bad. Selling momentum is staying very strong, bad. What do I have in my favor? Well, 45-degree channel is up. That's a good. Another one. It's at -1 SD. That's good because I know statistically the way bots and algos are programmed, they're already looking for a reversion to the mean trade, folks. And the trick is they may be using a shorter time frame, right? They may be using the 21 day or it doesn't matter. 21 to 50, 21 to 45. Okay. It's trying to understand on a statistical basis, has price gotten to a level where it has a high chance that momentum might slow down, that direction might slow down. Okay. Not reverse, but slow down. Because oftentimes you can come down here and say, oh, I'm going to trade this. I think I'll get a bounce back to the mean. You might, but it could also go sideways. I'm okay with that. I just don't want to lose money. So these are the primary indicators I use, and I know people use a shit ton of indicators. And if you're tempted to do that, understand that what you're really trying to do is find something that graphically represents price that your brain easily absorbs and understands. That's really what indicators are, folks. And it's more data for you to process. Every indicator, you got to process it. I don't like, since I use price, very simple, the source of all indicator data, I don't want to add additional logic steps where I might interject bias or I might make a mistake. Keep your charts clean and simple. I'm happy to share with you the settings for these indicators. This is what I teach my students to use, and some of them use different ones, and that's okay. But what I do stress is, look, do not dirty up your charts with a shit ton of indicators. All it's going to do is cloud the decision-making process and give you a false sense of either, yeah, this trade's going to go in my favor, or no, it won't go in my favor. You look at the way the data is created, indicators a derivative, period. It's just a derivative. And so use price as your primary trade trigger and your indicators to either add or subtract to the probability of success of the trade, whether they're in your favor or not. and use that final evaluation of both the price and the indicators, are they in your favor or not, to size up or down in a trade. That's it. If you're looking at a stock for the longer term, you like Micron, why the hell would you buy it today? Because people are impatient and they want to call a bottom. Well, I'm looking at price, and what did it just do? It just busted through the 50. That's going to be a problem. Why? Because tonight, if it closes there, there are going to be bots and algos that sell off of that, just off of that data point alone. In a nutshell, those are the only indicators I use. If you've got any questions, discussions, I'll open the room up for any of that. But yeah, any questions?
Boss, I am just very uninventive. I copy you and I use the 5 and the daily
Okay.
and look for price action that is suitable for whatever I'm going to do.
And how's that worked out for you?
When if I could sit on my hands like you do, I'd do a lot better. But
Hmm.
but I'm living and learning.
Well, you bring up a great point. A lot of people, I'd say many people, you know what they use indicators for? To justify a decision and a trade they know maybe is a lot riskier than they'd like to admit. Would that Does that sound right, Jamie?
Yeah, for example, recently when strategy was at 125, I said to myself, that is going down. I eventually got in at 115,
Hmm.
wrote it down to, I don't know, 90, made a shitload of money, then gave it all back because my sizing was wrong. So,
Right. So the indicators would have caused you to size down, right?
exactly, exactly.
Yeah. Sitting on hands more and more during choppy weekly. Absolutely, Bigglesworth. It's one of the hardest things we do here is not trade because there's this belief that trading is like everything else. The harder you work, the more you do, the better you'll get at it. I always use baseball's analogy. No, that's not true. You still need to know what pitch it is. It doesn't mean you get up the plate and swing it every pitch, and that's going to make increase your probability of success. So much of our job and so much of what we do in trading, we forget what is and this is why this has always been, well, it wasn't for the first 5 years. It has always been that I use price, okay? And the focus of trading is protect capital. I don't want to put money at risk unless the odds are in my favor. And the indicators that I'm going over with you today, and just so you know, when I started off in the business, I put a gazillion indicators on my screen. Look cool, right? Always had something to look at. But what I found is that they had very little predictive power, and that's what we're really looking for. Predictive power. I think anybody could look at this MicroStrategy chart, and if I asked you, "Hey, what direction is this headed?" Well, it was down, and now it's sideways. You don't need a freaking indicator to tell you that. If I said to you, "Hey, when would you buy this?" Maybe here when it breaks this level. You don't need an indicator to tell you that. The indicator is just adding to or taking away from your probability view for the trade to be successful in the direction that you choose. Zayden, so your indicators tell you how much money you should risk, position size. That is exactly right. I start with a 4% position, and depending on my indicators, depending on my R factor, how much I can make or lose, and the multiple of it, that's what causes me to size up and down. Support, if all the only indicator you need is support and resistance, folks. Why? Because that's what bots and algos use. True bots and algos are trading off of support and resistance. They're doing off of very short time frames, right? But if you're looking at MicroStrategy now, one of the things here is, okay, at least it's not trading at +2 SD up here in the red line, because what would that mean? Well, now I've interjected a new risk, which is what? Uh-oh, bots and algos often like to revert. But historically, what has MicroStrategy done in the last 45 days? It's pretty much hugged this white line. So if I was looking long here, I'd be a little bit concerned. What it's telling me over the last 45 days is this thing wants to go back down below this white line. And no, indicators don't take into account news. They don't take into account possible outlier news being reported that Michael Saylor, it doesn't, right? Purely price. But that supports my view, which is price is the best indicator representative of all available information out there. So if your trade looks good, but your indicators look bad or not in your favor, well, if all my indicators look bad, Zayden, it will go down to a zero size. That's the way the website sizes stuff. It will literally take it down to a no trade. What do you notice about Cuz? It hugs, right? It hugs the mean. So where would be a much better place to go long? Well, I don't know when it's below the mean, because at least you're going to get that push towards back towards the mean. It's trying to put that in my favor. Okay. So I get some space. What do I not like here? Look at this. As it's gone up, what has the MACD done? Gone down. Buying momentum is slowing meaningfully. The buyers might be getting a little bit worn out. Doesn't mean it will go down, but it does mean it becomes much more susceptible. Price action does to any big seller that would come in. I don't want to deal with that. So therefore, I'll just size down the trade. I want to stress that there is no indicator out there that's going to make you money. Indicators should not be triggers, period. They are from risk management, from the context of either or strengthening the probability of success of a trade or weakening it. If you're looking when to enter individual stocks, right? If you like Marvel, for example, right? Well, first thing I'm looking for is support and resistance level. Here's one, here's another one. So we should get a bounce. But what do I notice about Marvel? Well, prior to this move, it's been trading between the -1 and +2. So we are getting very close, or the probability is rising that we're going to get a reversal back to the mean trade. That's all that's telling me. It's oversold. Think about the days here. Oh, it's a green day. I should buy it here because it certainly can't go down anymore, right? Oh, here, I think and if you find yourself having those conversations with yourself that you're making an opinion based on no data except that what you think will happen, you need to step back and first look at price. And then, secondly, at the very least, use the 50-day, the 200-day, and the standard deviation channel. All right. I will put this up. If you have questions, ask me them now because this is the time where I can really help you learn to use the correct tools because as I showed you before, there's thousands of studies, thousands, and they all have really cool names. Okay. But all of those studies are derivatives of price. And I don't want to go through and back test all those indicators. So I stick with what brought me to the party. These are the ones I've used. If I was looking long on EOSC and price was here, I'd be very cautious. I might even stay off the trade. Why? Because statistically, I am overbought based on the last 45 days. But that's only one indicator. All the other indicators would have to line up in a negative column for me too. But this is just risk management because most people can't handle the go or no go. So this is a way for you to take a small trade, a small trade. I mean, what's the highest potential here today for EOSC? How do you read this chart? I'll tell you how I read it. I've got divergence on the MACD. Selling momentum is definitely dying. Just as I'm not going to jump in out of a trade because of a single indicator, or jump into a trade because of a single indicator. I'm not going to use this divergence to tell me, oh wow, divergence is there. I should definitely get in. No, it's an added positive that if price does continue to go up, this is going to flip. We're headed there to flip to the green. We often get into trades 2 to 3 days before this MACD flips in our favor. It happens all the time, which makes sense mathematically since the MACD is a derivative, right? And we're using price. So the indicators are going to lag. And that's the other problem using indicators as a trade signal is they're lagging. They're all late. They all have a component of them that is old. So why would you trade off of old information? The best, most recent information is price action on a daily chart. Yes, but the takeaway that I would say is whatever indicators you're using, keep it simple. Make sure that you have your time frames of the indicator matching what your trade outlook is. You can't use a short term like this. If I bought EOSC and my hold period is 5 years, okay, I don't particularly care what it's doing on a daily basis. I'm probably going to go to the monthly at that point. I don't know who the hell would want to, have a 5 year outlook on a stock. That's, the stated holding period. If you're looking beyond, 90 days, use your weekly chart. I use the daily, day in and day out for all of my trades. All right, everyone, thank you for taking the time today. I will put this recording in the room. If you have any additional questions, please DM me or put them in the room. I hope this helped. And I'll see you in the room.
They ain't got no muscle, no hustle, no backbone. I stand alone, not tripping, just saying I'm different.